Hello and welcome to Module 4 of the Stock Market Foundations course. I'm Jason Whaling. This is the final module. If you're just joining us, don't worry. Go ahead and watch this one, and I'll link at the end of this video to all the other modules to get your questions answered. So in this final module, we're choosing our path to profits. We've looked at what the stock market is, what stocks are, what volatility is, what risk is, the different types of traders, the different types of investors, and all of that fun information, that good info comes down to how do we make money in the markets. And profiting from the markets requires some analysis of companies and stock prices to be successful, whichever path you choose. There are two types of analysis techniques. There's fundamental and there's technical. Fundamental analysis is primarily used by investors to analyze a company's underlying financial strength, while technical analysis is primarily used by traders to analyze price movements of a stock. So in this module, we're going to take a look at how fundamental and technical analysis are conducted and how we can use them to our advantage. Then we will conclude with a look at how to best apply the information to be successful on whatever path we wind up choosing to invest or trade. We'll start our discussion with fundamental analysis. If you plan on being an investor, it is critical that you understand the basics of fundamental analysis. Fundamental analysis is the process of understanding the inner workings of a company. It breaks down all the facts of the company and brings you close to what is actually driving the company's profits or what is actually causing the company to fail. The primary purpose of conducting analysis is twofold. First, to ensure the company is financially strong and will continue to make money in the foreseeable future. To determine whether a stock is overpriced or underpriced is the second. Fundamental analysis is done using basic financial information pulled from a company's financial statements. Now, don't worry, you don't have to become a forensic accountant to do fundamental analysis. It can actually be done quite simply using a couple of financial ratios, and we'll have some other videos about how to use financial ratios to find great companies over on the YouTube channel, so go ahead and check that out. In the last module, I just want to touch on the example again. We gave the example of price versus value, so I'll go over it again. Let's say we have a TV that's on sale. It's Boxing Day, it's Black Friday, it's day after Christmas sale, Labor Day weekend sale, whatever it is. We have a $1,200 TV that's on sale for $700. So it's a $500 discount. We go online, we stand in the cold, we push and shove at Best Buy or Walmart or Costco to go grab that TV, or Target, wherever you may go to get the TV. People go and do that because they know the TV is worth $1,200. And the same thing happens in the stock market. We have a stock that's worth $1,200. It drops to $700, $500 discount. We go and we grab it up. We buy it because we know that the stock is worth $1,200. Fundamental analysis is what lets us know that the stock is worth $1,200. Otherwise, the price drops from $1,200 to $700, and without fundamental analysis, we don't really know the significance of that as an investor. So I just wanted to point out that's really, at the end of the day, that's what fundamental analysis does. It tells us how much is this company worth, and then we can go to the market and see if we're getting a discount or if it's overpriced. So there's fundamental analysis for you. Technical analysis, on the other hand, is all about the future price action and movement of a stock's price. It doesn't care at all about the company's underlying value. So in our example, technical analysis would be looking at the move between 1200 and 700 and say, why did that happen and how can I predict it again in the future? Fundamental analysis doesn't care. It says it's worth 1200, it moved to 700, let's buy it now. Technical analysis says it moved from 1200 to 700, why did it move? So there's kind of the basic two big differences here. And that's really another thing that's a big difference between investors and traders. Investors are fundamental, traders are technical. There's some overlap in what they use, but at the end of the day, at their core, those are what they're doing. So fundamental, we're looking at what is it worth and how much can we get it for. Technical, we're looking at where's it at, where's it going. So the predictions aren't designed to be concrete or exact, but more rather approximate to forecast the events that could happen in the future. And that analysis for technical analysis is normally done with charts and graphs. Though it goes a long way in providing an educated assessment or guess to the future trend or movement of a stock's price, it can be very, very subjective. It's glass half full, glass half empty. Two traders can look at the same chart. One sees it half full, the other sees it half empty. And that's part of what makes trading and technical analysis so difficult. The result of an analysis can be interpreted in the same way an analyst wants it to be. And this is where trading psychology comes into play. This is an act of the subconscious mind taking over and influencing the final judgment. If the analyst prefers a bullish market or an uptrend, the market predicted by a chart will more likely give the analyst a bullish or uptrend indicator, and vice versa. This actually relates to our discussion earlier, how we never trade the markets, we trade our beliefs. As a result of this prejudice, technical analysis is very, very subjective and to this flaw. And this is why many traders think of technical analysis as more of an art than a science, because keeping that subconscious mind in check is very, very difficult. And this is why trading psychology and knowing your own personal psychological biases is part of a successful trading plan. It's part of being a successful trader. It does not mean you or I are weak. It is looking at our anatomy and how our brain works and saying, okay, I accept the fact that I'm going to have a bias every time I read a chart. And when you keep that in mind and you know that you have a bias, you will be much more successful using technical analysis. It's just all about keeping ourselves in check as we trade to actively keep ourselves objective when conducting technical analysis if that's what you decide to do. Now it's time for you to choose. With all the techniques, strategies, concepts, methodologies we've discussed, it's clear that when it comes to choosing how to profit in the stock market, we have a lot of options. Some are better than others, but it's up to you to decide how much work you want to put in and what works best for you. Plus, thanks to my lawyers, I can't tell you exactly what to do. So regardless of what path or strategy, technique you use, we'll review the 3 factors to focus on to keep at the forefront of your mind as you continue learning and exploring how to invest and profit in the markets. So number 1, without proper money management skills and disciplined approach to trading and investing, no strategy will yield fruitful results. You need to make sure that you never take on a bunch of risk and blow out your account on one investment. Making small intentional investments at the beginning to ensure that you learn and your capital doesn't run dry. Next, when employing trading and investment strategies, we need to remember to stick to the rules of our system and not violate them in any way. The quickest way to lose money trading or investing is to set a profit target or to set a loss target and then say, oh, you know what? I know it's fallen 10%, but I think it's going to be different this time because X, Y, Z. No. If you say, hey, if this falls 5%, I'm done. When it falls 5%, you have to honor that. It's okay to take losses. Losses are part of trading and investing. That's something that's really important to understand. You are not a bad trader or investor if you lose. You are a bad trader or investor if you lose because you didn't follow your rules. That's when you're a bad trader or investor. And finally, before making a trade, you should always double check the long-term trend of the market, bull or bear, because 3 out of 4 stocks follow the market. All right, and that does it for the Stock Market Foundations course. Once again, my name is Jason Whaling, founder of the Wealth Titans, and this concludes the Stock Market Foundations course. I hope you learned a lot and you are more confident about beginning your trading and investing journey. If you have any questions or comments, please let me know in the comments section below. I do read them and I will happily answer any questions you have. I want to thank you again for watching. If you stuck with me through this entire series, if you just joined or jumped in midway, I'll include links at the end of this video for you to, catch up on some of the parts you missed, and be sure to subscribe to my channel for more investing and market insights. To your investment success.